The BLS says that the average American's wages are growing, but what is the truth? So we're going to look at this is part two to the non-farm payrolls print that came out this morning, the report from the BLS. One of the areas that that report looks at is wages. And of course, they report that wages are growing, but we want to look at what is actually happening with wages, as this is a critical factor for the quality of life for most everyday average Americans. So remember that inflation is a monetary phenomenon, and here in red is the rate of change of the underlying money supply. As the money supply inflates and expands and more dollars are created, those dollars can then go chase. There are more dollars to chase a similar amount of scarce goods and services. Therefore, the price gets pushed up. So inflation really is referring to an expansion of the money supply. Rising prices are just kind of a consequence of monetary inflation and an expansion of the money supply. Well, here's the annual rate of change of wage growth according to the government, and M2 money supply, which is a broad way to measure the money supply. Remember that about 90% of all dollars created are created by a private bank through credit creation, through an extension of a loan. That is how, in a debt-based monetary system, that is how the vast majority of dollars are created. They aren't printed by the government, not by the Fed, not by the Treasury or the Mint. They are created by a private bank. M2 measures that kind of broad money supply, including some amount of private bank credit creation. This is different from M0, which is narrow money, and that base money, and that refers to the Treasury and the Mint on the one side with currency, and then the Fed with bank reserves. That is M0. M2 is a much better way to look at it. Here we're looking at the annual rate of change. We can see that M2 growth is running at 5% on a year-over-year basis. They tell you headline inflation is only 2.7, but actual literal definitional inflation, which is the expansion of the money supply, is growing at 5%. And wages are, generally speaking, for the past 25 years, wage growth has been below the M2 money supply growth. So here is another way to look at it. I think this is where the video got cut off. Here's the nominal earnings for the second quartile. And this is a nominal figure, so not inflation adjusted. And this is what kind of on a surface level, you would look at this and think, oh, wages are growing, everything is great. But again, you need to look at those wages, the rate of change relative to the rate of change of the money supply. So here we use the M2 money supply as a denominator, and we can see that those weekly nominal earnings for the past 45 years, yeah, they are growing, but they are growing slower than the M2 money supply. That is why the line is going down. And here we're looking at total wages. So the yellow line calculates using the average hourly wage, the average hours worked per year, and then the labor force, calculates basically the total wages earned in the U.S. by all workers. And again, this uses the average hourly wage, the average work week, and the labor force. And what we can see is for the past 45 years, wages as a share of the money supply, it used to be about 78%, or excuse me, 88%. It is now down 50%. So the actual purchasing power of those wages that are being earned, and again, in nominal terms, looks great. But as a share of the money supply, wages are not growing faster than the money supply. Therefore, purchasing power is actually going down. So you're earning more money, but it's purchasing you less. And by the way, you can see where this kind of really went non-linear. The average hourly wage and the average annual wage as a share of the money supply is down 50% over the past 45 years. Again, what that is indicating is the money supply is growing faster than the total wages. Ideally, at the bare minimum, both of these lines would be flat, indicating that the money supply and wages are growing at the same rate. It would just be a horizontal line. Unfortunately, that is not how it is. Here's yet two more ways to look at the same kind of concept. Here in red is personal income. This is a relatively broad way to measure earnings and income of kind of average Americans. This, like I said, is broad and includes things like to some degree, investment income. It's really kind of not exactly the best aggregate number to use for the blue collar average median American. Maybe, the upper leg of the K might get a lot of yeah, net interest income from money market funds and savings, CD savings accounts, and their stock portfolio and dividends, right? So personal income includes a lot of that, but even with this broad of measure of personal income as a share of the money supply, it has been down. It set a peak here in 1997 and has just been down pretty relentlessly. By the way, this declined from 182% of the M2 money supply down to 117%. So what is that, about 55, 60% decline over just the past 25 years alone. And then if we look in white, average hourly wage divided by gold, what this tells you is for the average hour of work, how many ounces of gold are you earning with that average hour of work? We can see that back in the 70s, it was about 0.08 or 0.09 ounces of gold for the average hour of work. And now it is just 0.01. And again, the reason we use gold as a denominator is that over long periods of time, it is useful and accurate in tracking actual inflation, actual monetary inflation. That is what gold is best at, not on an hour-to-hour basis or a day-to-day basis, but on a year-to-year, certainly decade-to-decade basis, it is useful. So we had mentioned the dollar liquidity issues, I think a day or two ago, and I wanted to provide update on that because interestingly, SOFR has not, the spread has not come in yet. It's been a couple days. Normally, you will see this spread spike where SOFR goes above Fed funds, indicating liquidity strains or shortage of dollars in the financial plumbing, but then it'll reverse right away. Well, we're not really seeing that. And the other thing I would point out is normally you see this spread spike at quarter end or year end. At the end of December 2024, the end of the month, you saw a pretty significant spike where this spiked 20 basis points above the federal funds rate, SOFR, which again, that is that free market measure of relatively free market measure of supply and demand mismatches when it comes to the overnight dollar loans, basically the demand for those overnight dollar loans. If there is way more demand for dollars than there is supply, you get SOFR, the rate or the cost of that loan, going up. And here we're looking at it relative to the federal funds rate, which we see in white. And so the spread has not come back in. It is not the end of the quarter, is not the end of the year. It spiked up to the IORB rate and is actually now slightly above that IORB rate. As you can see, that is quite rare. This chart goes back to late 2023. It is rare to see SOFR go above IORB, and IORB is one of the ways the Fed kind of manages interest rates. And, we are still nowhere close to, say, a 2019 repo rate crisis source spike. This situation, SOFR went about 300 basis points above the federal funds rate. I'll also point out when there is an overabundance of dollars and a shortage of demand, you get the opposite, which is where SOFR actually goes below the floor that the Fed sets with the reverse repo here in red. And so we can see a negative reading. That indicates there is an overabundance of dollars and not enough demand. Therefore, the cost of those dollars goes down, and that is that interest rate. So definitely something to keep an eye on. I wouldn't say things are imminently at a crisis level, but it's certainly something worth keeping an eye on. And so bonds are getting bid off this week, non-farm payrolls. Again, since the Fed started to cut rates, the 30-year and the 10-year and the 5-year are all up. And this is, we had been referring to this as a bear steepener if you look at it from the start of the cutting cycle, which is a useful way to think about it. Well, now with the 2-year and the kind of short end of the curve, those rates are now actually lower than when the Fed started to cut back here in September of last year. So now we're kind of seeing a twist steepening. And I will throw on the 30-year minus the 2-year. Again, we are in this kind of general steepening trend. And we have flattened a bit over the past 2 days, but generally speaking, we are steepening. What that means is the difference between the purple line and, in this case, the red line, which is the 2-year yield, that difference is growing wider as the pink line is going up. That indicates one of two things, depending on if it's a bull steepener or a bear steepener. Remember that the value of the bond is inverse to the yield. So here we can see bonds are getting bid all across the curve. Even the 3-month, by the way, has a pretty significant move. There's even people talking about a 50 basis point cut in September. A jumbo cut that is seen as a jumbo cut, a sign something is imminently wrong. Core CPI is running at 3.1, PPI is above 3. The inflationary pressures, as we looked at earlier with ISM prices paid and the 4-month lag to CPI, inflationary pressures are definitely more significant than the labor market is weak. Sure, the labor market is tightening, as we can see, but it is not imminently catastrophic. And so, the Fed is really in a tough spot with that. And here's how markets are responding kind of cross asset. Again, yields are down to 10 and 30. The dollar is down too by about 0.6%. Not a major move. It's kind of just at the lower end of this range that it's been in. Gold is just ripping higher and higher. Tried to pull back yesterday after its parabolic run. Couldn't even really pull back. And it is setting a new all-time high. Again, what gold is signaling is a loss of purchasing power of the dollar. When gold is ripping higher, that is what that is indicating, generally speaking. Equities are down right now. We can see the S&P is down about 0.5%, was down close to 1% earlier. NASDAQ down marginally 0.1%. IWM, the small and medium cap, the Russell 2000, is green. Ever so slightly, but they are green by 0.1%. So that kind of IWM to QQQ trade we talked about, I think, a month ago, still kind of looks like the move with rate cuts coming and that sort of thing. Not financial advice, of course, just a thing, a concept, a idea that I'm kind of thinking about as we see, weaker labor market mixed with kind of higher inflation. The Fed has kind of indicated that they're going to look at the weaker labor market and cut. Okay, well, if they're going to start cutting, as the 2-year is indicating they will, remember, the Fed just follows what the 2-year yield is doing. They are not that important. They just follow the 2-year Treasury yield. If we're going to go into a rate cutting cycle, then the most levered companies, the most interest rate exposed sort of companies, because they have the most debt, is the IWM, the small medium caps. That is IWM, and likely to kind of outperform, especially with that top in NVIDIA. NVIDIA, by the way, since we made that video talking about a potential top on NVIDIA, it has basically just been down only since that video. So whether or not it was the top is beyond my pay grade, but it was certainly a short-term top. So anyways, yeah, big moves, especially in the bond market. There's a big bid. The bond market is taking this labor report as very weak. And the gold market, again, is signaling and indicating that, okay, you're going to act on this just normalization, slight weakening, slight tightening in the labor market, start cutting rates with inflation where it is, with nominal growth where it is, with real GDP where it is. Okay, well, the dollar needs to be devalued versus gold. And that is what it is indicating again today. Again, it's up another 1.3% today after this parabolic run it's already had. DXY relative to other currencies down slightly, 0.6%. But again, it really what matters is the dollar's purchasing power of real scarce items, like, for example, gold or housing. That the dollar is getting debased, and the market is indicating a further loss of purchasing power with the dollar. Volatility, of course, spiked on this gap up that we had, but has come in a bit, still with a 16 handle. So anyways, hopefully that was helpful. And yeah, sorry about the technical difficulties. I will catch you in the next one.